All right. Good evening, everyone. Welcome to the very first session of the Capital Conviction webinar series. I'm Shabrish Menon, Managing Principal of Phenomenon Investments and your host today. Thank you for making time on this Tuesday evening to join us. Capital Conviction webinar is created for one simple reason: to cut through the noise and bring fact-based, no-hype insights into the most important capital allocation decisions investors take. Whether you're building wealth for your family, looking for passive income, or just sharpening your due diligence process, this series is designed to help you approach capital allocation decisions with clarity and high conviction. For those new to Phenomenon, we are a fee-only registered investment advisor based here in Washington and built on the principle of transparency and client obsession. We serve corporate managers and executives as a family office providing personalized, comprehensive advice across equity compensation, investment strategy, taxation, and estate planning. Now, I'm thrilled to welcome our guest today, Alex Birch, partner at Veritas Equity Partners. Veritas is a private real estate investment firm that specializes in Washington multifamily real estate opportunities. They have built a platform that gives investors access to real estate that's typically locked up behind large GP funds without the operational headaches. Veritas is also a listed partner on the Phenomenon Family Office Network. Alex brings deep experience in sourcing, underwriting, and managing multi-family assets. And today he's going to walk us through how he thinks about this asset class. After he walks us through the presentation, we will have Q&A, so feel free to note your questions along the way. With that, I'll pass it over to Alex for the presentation.
Hey, thanks, Shabrish. So I'm going to hump on camera. Can you see me? And can we see the presentation?
Yes, we can see you and the presentation as well.
Okay, perfect. So I think what I want to do today is just introduce this concept of multifamily investing in general. So I'll speak to Veritas and what we do and why we do it. But I think the lens that's interesting for everybody is, whether you invest like with a group like ours in Washington State or you're looking at other states, I just wanted to kind of outline the way that we're thinking about this and the types of deals that we're buying. And it should give people good context in terms of questions to ask and things to look for in terms of pursuing their own private real estate investments, specifically tailored to multifamily. So I've just kind of tailored this down. Our normal deck that we walk through with potential investors is about 25 slides. I think this is about half that. But we just want to go ahead and introduce the idea and have a little dialogue about that. And then Shabrish and I will chat after. So just a little bit about us. So we, like Shabrish mentioned, we give opportunities for people to participate in multifamily apartment building investments fractionally. So if you have $50,000 or $100,000, we will pool your money as the investors, and we as the fund sponsors are the ones doing all of the work. So it's 100% passive for people that decide to invest with us. But the cool part about us and other groups, and something that I would encourage you to look for if you're going to make an investment like this, is to find a group that does one thing really well. There's a lot of groups out there that do a lot of different things. I think that's a tough road to go down. You just can't possibly be the best at all of them. So really finding a specialty that you believe in and a niche that you believe in is super important. So again, about us, we're identifying, we're acquiring, we're managing workforce housing apartment communities across strategic regions only in Washington State. So that's Seattle, Washington. If anybody's not from the state, that's not the East Coast. And we really only buy in certain pockets of Washington State where we have expertise. So we've been at this since 2010. And again, following this exact guideline. So we've got about 15 years of experience in this. We have a ton of people that we work with on a consistent basis that we've just built out over time. Our performance has returned an annualized return of 32% across all of our deals, on the lower end being 15%, up to 70% on some deals that just went exceptionally well. But our average is 32% a year. We don't expect that. That happens when the market does, really great things, or if interest rates come down or whatever it is. But what we're targeting specifically are deals that are going to create that 15% a year return. which we'll get into a little bit more later in this presentation. We've got about $55 million worth of these apartments under management today. So we are growing much faster than we did in the first 10 years just because we've identified this niche. So it's been a really fun ride, but we really have narrowed down and became specialists in this exact thing that we're doing. So, now we're doing about 1 to 2 deals a quarter, as opposed to 1 to 2 a year. So it's been a fun journey. Something that I like to talk about with people, and again, this is educational, so it's not, just, hey, come invest with us. It's what questions should you be asking and what should you be thinking about if you're going to pursue, this type of investment with another group. So location is obviously, in my opinion, the most important thing that you can possibly look at when you're thinking about where to invest your money. There's a lot of groups out there that will chase unit counts, or cheap buildings or cheap units, just to say, hey, I bought this 100-unit deal for X amount of dollars. But you really need to become aware of the risks associated with different parts of the country, and different markets, and understand what's going on there. So we only invest in Washington State, and there's a lot of reasons for that. We know it really well, and that's where all of our deals are. But more importantly, if I was starting out from zero and we could pick any market to become specialists in, I would still pick Washington State. And everybody knows this that knows the area at all, but it's basically just unaffordable to purchase a home here now. So the majority of people are not able to buy. There is nowhere to go to build more space. The land is all basically absorbed. So it's called urban sprawl is the term that we think about in terms of, you think of markets like Texas or Arizona, Florida, Colorado even, and there's just a lot of land. There's a lot of room left to build. So, why would you live in maybe an older vintage apartment unit when you could go live in a brand new build down the street? We just don't have that here. Wallet Hub also came out with a study last year that for 2024 that announced Washington State as literally the number one state in the country for economic performance, and that took into a lot of factors. But it's basically just a really incredible measure of how strong the economy is in Washington State. And again, combining that with the fact that homes are so expensive and so unaffordable, it just creates this massive demand for, affordable housing for people. So that's, again, why we're staying here. So I mentioned this earlier, Washington, and there are other markets like this in the country. Think San Francisco, think New York, Boston, Seattle, obviously, or the whole Pacific Northwest in general. So it's not just here, but we'll just kind of keep this to Washington because that's where we specialize and that's what we're talking about. But we have kind of the trifecta isn't accurate because there's probably multiples over 3 times of why this happens. But again, going back to that landlocked situation, I mean, we've got water on one side, we've got a mountain range in the middle of the state. There's just nowhere left to build housing. Our policies are actually quite business friendly. We have no state income tax, we have low property taxes. So operating these deals and operating them as businesses, it works quite well here. We also, as everybody knows, are an absolute powerhouse in terms of employment. So think Microsoft, think Amazon, think Zillow. I mean, the list goes on in terms of companies that are based here. So, what that means is there's a ton of households right in the Pacific Northwest region that are $300,000, $400,000, $500,000+ W-2 income households. So that's why the houses are, $1.5, $2, $2.5, $3 million to buy, just because there's enough people that can afford them. So the challenge that creates is, where are the people that are supposed to be sort of like, I think of it like the backbone, the support staff of the region, right? So all blue collar workers, service workers, really the people that make all of this stuff hum in the background. I mean, even down to teachers. And I mean, there's so many like amazing and super important employee situations that they need housing. But again, it's really, really tough to afford a $2 million house. If you're making $80,000 a year, it's impossible. So that's where we come in. And we provide, great places to live for people that make that like $70,000 to $100,000 a year income. This also, speaking to this bar chart on the left here, goes to why our vacancy rates are so low. So what a vacancy rate is how many empty units do you have? If you have a 20-unit apartment building, how many are empty at any one time? And in other parts of the country, you could see Texas's average vacancy is almost 10%. Arizona's 8+. I mean, it just goes down. Washington State on average is at 5%, 5.2. We specifically operate actually below 4%, just based on the type of deals that we're buying in the regions that we buy. But again, all this rolls up to just consistent, steady opportunity to make reliable cash flow and gains on your money with these types of deals. So again, going back to cash flow upside, the market's amazing. All of these things are things that you should be thinking about and asking questions about if you're going to invest in a particular market specifically related to real estate. I mean, anything in general, but specifically to real estate. So another kind of place to go and start asking questions if you're going to make an investment like this with anybody is what type of deals do you buy? And the reality is there's a lot of different types of apartment buildings. There's a lot of different size buildings. There's vintages in terms of when they're built. Are they class A? Are they class B? Are they class C? Are they pure Section 8? Are they kind of on the super low end? Like, these are the questions that you need to be asking because that changes the business model across the board. At Veritas, we only buy these very specific types of deals. So these are buildings built between 1960 and 2000. We buy 20 to 75 unit apartment buildings. So we're not buying the mega complexes that are 200-300 units. We're also not buying, fourplexes and sixplexes and things like that. So by far and away, our average is between that 20 and 75 unit building size. And we're looking at rents too. So when we first get deals sent to us, we say, hey, is there at least 15% in the rent to get increases after we buy them and renovate them over 2 or 3 years? So we don't have to do this in the first year. We never do. Our business plan is to do this over 2 or 3 years and what's called stabilize the building. But again, that's an operational efficiency thing that, it took a long time for us to figure out, but that is where we are creating that value on the back end. In terms of cosmetic improvements, that's the rehabs. We are typically at around $12,000 per unit to just think carpet coming out, LVP flooring going in. That's like the vinyl hardwood plank. We're doing kitchens, but we're doing cabinets. We might paint them. We'll bring in new appliances. Nothing permitted. No big construction projects. Like, we're typically turning these things in a week. So the jobs are consistent, and we've done hundreds of them over the years. So this is also just a risk containment piece of our investment philosophy. Is we're not reliant on the city or counties to get permits and do any kind of big construction projects, because that's just fraught with risk, in my opinion. Going into that further, again, our business plan is the same no matter what deal we're buying. And this is what I would encourage everybody that's listening to this. If you're thinking about getting into this, maybe with your own money, or you're looking for partners to invest with along the way, having a really clearly defined strategy, not only for what we buy and what we're looking for in terms of the type of deals that we're buying, but the actual operations of it. And I feel like very few people talk about this part, but this is really where the deals either thrive or die. You can buy a great deal at a good price, but if you can't manage it and if you can't actually execute on the business plan, it's not going to be worth more money at the end. So you really need to be sure that you're vetting the operator, and have they done it before? How many times have they done it before? And what's the exit strategy? So this number 4 over here, we typically will sell when the deal is maximized in terms of getting the net operating income. That's the rents minus expenses to where we want them to be, just because it's the best use of capital. So if there's a bunch of money in the thing and it's spitting off some cash flow, that's okay. But once the equity reaches a certain place, I like to do another one of the strategies that we love about this is a 1031 exchange. And we take all that growth on the value of the building and we roll it into another one, and we just rinse and repeat it. And that's really how you build the most value in this game, is buying, operating well, driving up the income, and then selling it whenever the time is right. But for us, that's typically between 3 and 5 years. No need to read all of this, but just to give you an idea of what these buildings typically look like and how we end up operating them and selling them. These are some past exited deals that we've bought and stabilized, and maybe we've refinanced, maybe we still hold them. It just kind of depends on the deal. But these are the types of buildings we're buying. So it's when you're driving around in these neighborhoods and you're seeing what appears to be maybe like a smaller apartment complex. I mean, 62 units is pretty good size, but here's a 28 unit. And these deals, they're everywhere in Washington. So that's also market dependent. If we were for some reason like only had to buy in certain markets that didn't have these types of buildings, we might look at different, vintages or sizes and price points. But for our market, there are thousands of these things in the state, literally, that are maybe they're multi-generational, maybe the grandpa of the family started buying these things in the 60s or 70s or 80s, and has just been holding them for 20 or 30 years. And that's typically who we're buying from. But these are the types of deals that we're buying and what they typically look like. So just to give like a specific example, so this is a deal that we're under contract on right now. It's in Everett, Washington, which is about a 30 to maybe 35-minute drive north of downtown Seattle. So one kind of distinct thing about us is we do not buy in the city of Seattle. Seattle just has some challenging rent laws, and it's tough to be a landlord in Seattle. So to us, that just presents risk. So we love the Pacific Northwest and we love Seattle and we love, the Seattle, Washington market and all of that. But as far as buying these deals, we don't buy in the city of Seattle, we buy outside of it. So this is an example of that. It's 30, 40 minutes from Seattle. So a lot of these tenants probably go into Seattle every day, so it's accessible. But we're in a different county. So there's different laws and different landlord laws that make it a little bit smoother to run. But this is a perfect example. So we're buying this thing about 20% below market, which I'll show you on the next slide how we get to that number. An in-place cap rate, don't worry too much about that. What that means is you're basically getting a 6+% cash on cash return from day one. So if somebody were to invest $100,000 in this deal, we're going to be giving $6,000 to $8,000 back to you in distributions in the first year, second year, third year, and it just grows every year from there. This is a 24-unit building. So again, it's right in that sweet spot for us in terms of size. It's $4 million. It's $4,050,000 specifically. They're all 2-bed, 1 baths except 2 of the units, and 14 of them have been renovated. So we've got 10 left that we can go in and do those cosmetic rehabs that we talked about. And the rents are low. So that's here, but I'll show you a different slide here that kind of outlines it better. So this is one of those data points that we like to look at, very first in terms of, hey, what does the market actually support for current rents? And we try to be really conservative with our underwriting on them. So this is a perfect example. This box here on the top left that has the yellow columns here. So current rents, this is what the current owners are getting for these. So we can see across the board, they're getting about $1,450 to $1,500 for the 2-bed, 1 baths, and $1,275 for the 1-bed, 1 baths. Down on the bottom left, this is actually a data pull and you can see the sample size here. So for the 2-bed, 1 baths, within 1.5 miles of this exact building, there's 41 comps in the last year for rents. And this is not like advertised rents. This is actually placed rents. And you can see here, the average is about $1,800 a month for those. And it goes up to about $2,000 a month for the 75th percentile. So we have a ton of room here in terms of operational efficiencies to increase the rents over time. And we will plan to do about a 7 to 9% rent lift on this building for the first 3 years to get it up to market. And just by doing that, this $4 million purchase will be worth just shy of $6 million when we hit those target rents. And that's when we will look to actually sell the deal. So again, example pictures of, this is how some of the units might look today, because these, it's a 94 construction. If they haven't been touched in 20 years, they'll look likely like this, and we'll renovate them here. So we're not doing anything too crazy, but they end up looking a lot nicer and they rent a lot easier, and people are really happy to live in them. So that's just a kind of before and after example of what we do inside of these things. Here's that snapshot of the price per pound, or price per door is another way to think about it. So this is the deal, this Ridgeline deal that we're buying. So you could see it's $166,000 a door, $167,000 a unit. And these are comps that are literally on the same road in the same area that have sold in the last year. So this is another point that I see other funds, investment firms, syndicators, they try to use comps that are, 3 years old, 5 years old, or they try to use this metric about like, hey, this developer built this thing for this much money and they're going to lose, this much money and that makes it a good deal. Like that doesn't necessarily mean it's a good deal. It just means somebody overpaid for it. So it's really important to see this from like, what does the picture look like? And is it recent? So, here we can see 200,000 a unit sold literally 6 months ago. Here's one that was last June for 203,000 a door. Here's one that was last August for 203,000 a door. So we are kind of coming in immediately and recognizing a pretty big premium just based on the buy side. But once we drive those rents up, it should be a slam dunk to sell it for the price that we want. So that's going back to that exit strategy that we're talking about. And I know that I'm just throwing a ton of information at you guys, but this is an example of how we look at return metrics on specific deals. So most of our deals are about a 3-year hold. We tell our investors, hey, be prepared to hold for 5, just in case the market doesn't cooperate and we need to hold. And we get 7 or even 10-year fixed debt. So that's, again, a big question to ask your operator that you're going to be investing with, or yourself if you're going to be buying these things, is what's your debt strategy? And if it's not a long-term fixed rate debt, if there's variable debt involved, if there's bridge loans, if there's any of these things, I would personally run for the hills, just because you're absolutely banking on the market doing something in your favor, and that's just a guess. And like, we don't guess, so we'll never do that. We look at what's the current cap rate and what are current interest rates, and we calculate everything based on that. So if the market does go up and everything goes better, we'll just execute the deal faster, which will make the return better just from time value. But at the end of the day, we're not planning on any of that happening to reach that $6 million sale price. We're just executing the business plan along the way. But we can see for this one, if we do this in 3 years, it's a 26% forecasted annualized return. And if we do it in 5, it's a 20. So even if things don't go perfectly, we're still looking at that 15+% a year return, which is what we're always targeting, but we're just trying to be conservative about that. And that's it. So I know I just talked straight at y'all for 15, 20 minutes. I appreciate that, but I am done.
Thank you, Alex. So if you have questions, you can put them in the comment box and we can take them. But Alex, I have a few questions that came in early as people registered, so maybe we can kick things off with that. I know some people joined late as well when you spoke about the Seattle market and Washington in general. Can you speak a little bit more about the attractiveness that you see in Washington relative to other places, especially when it comes to certain regulations around rents and other things that could restrict the kind of returns and outcomes you can produce here?
Yeah, absolutely. So this is the part that we see, particularly new syndicators and new fund managers that maybe didn't do it themselves first, or they just got right into syndicating and haven't actually learned the hard lessons along the way. But anybody that started syndicating in the last 5 years, you've got to ask a lot more questions, just because debt was 3.5%. Money was really easy to find. Like everybody was liquid. That was a strange time, and it was. I don't want to say it was easy, and I give props to anybody that got in the game, but at the end of the day, you could have made a lot of mistakes and the deals still could have worked out okay for those first few years. But what we're seeing now are people that got in over their head. They didn't capital plan appropriately. Their debt that they got, maybe it was 2 or 3 years fixed, maybe 5, but we're just seeing a lot of this happening now where the deals were super skinny going in and they were just buying anything and everything they could. And now their debt is coming due and it's going from 3.5%, 4% to 6.5%, or maybe even more if they don't have good credit or can't get these agency loans. And so that's where the strength of the market is so important. And we're seeing this, like so many deals are upside down in Arizona, in Florida, the Southeast, the Sun Belt, would be another way that people talk about this, from this exact thing happening. And then pairing that with the ability for all of this construction to have brought in so many units. So at the end of the day, if you're in a place where they can just build more and the price per pound is pretty close for developers, they're just going to keep building. And all that does is create a massive inventory for all of the renters to choose from. And your vacancy rates shoot up, your rents are down. I was just talking to a sponsor the other day in Texas, rents are down like 24%. Down. Like we haven't had down rents in Seattle ever. Like they might stay flat, they might go up 1 or 2% or something, but our rents don't go down. And it's just a supply and demand thing. It's not terribly complicated.
Right. We have a question here from DJ. He says, with Veritas, do you invest in a specific project or as shares? How do you think is one better than the other?
Killer question. So there's pros and cons to both. So shares would be like if we had a closed fund. So there are funds out there that you can invest in. It'd be kind of similar to a REIT, but they're private, and you're buying shares in this fund. So I think that those can be okay, but your returns are pretty much always going to be less, just because you're spreading it across a bunch of deals. Usually there's a lot of fund administration inside of those. So the accounting costs, the audit costs, the reporting costs are really high. We do specific deal by deal. So we're going separate entity for every single deal, separate bank account for every single deal, separate deal docs for every single deal. And I just prefer that. I also find that investors like that because they get to choose like, hey, I like that one. Like I want to invest in that one. And then they can look and see the exact business plan for the exact deal that they're invested in and then get updates on the exact deal that they're in, instead of like these kind of more broad fund updates that, maybe there's 10 deals inside of the fund and 3 of them kind of flopped, 3 of them did really well, 3 of them are super neutral, and the return is basically aggregated down. We like going deal by deal.
Thank you. So in terms of, just in terms of how you anticipate the future, I think there are 2 components here. One, you already spoke about the rental part of it. The other one is the interest rate. I think Feds are going to have a meeting this week. Mostly they are going to be holding steady as is expected. So how much of the influence in terms of the deal outcomes have you seen in getting impacted by either of these factors, especially
Yeah.
given, the future may not exactly look the way the past 10 years has been, specifically in the interest rate scenario?
Yes. So so debt strategy in general is near and dear to my heart. It's the thing that I think about the most. I also think it can be the simplest thing. If somebody just wants to really be disciplined and stick to like one particular lane, I won't do, like I mentioned earlier, I won't do any variable stuff. I'm not going to forecast the market. My perspective is anytime you're forecasting or guessing, what's going to happen with the market, and then you're basing an investment decision based on that, it's not a super scalable way to do it. Like I know that there are economics in the equities markets, a million times more than me about that makes sense to just, if you believe in something, you buy it, you hold it, you let it run, right? Like with apartments building investments, I'm a huge proponent of what are the interest rates today? What does history say? Because we study it and we want to understand, like, hey, if this is like a super low period, like I remember when it was, sub 3.5% for commercial loans, money was basically free. And in my mind, and I was young, like I started buying these things when I was 22. And I hadn't been through any kind of big cycles, but I could see, you just look back at the 10-year treasury and you say, okay, this is the lowest it's been in forever. Like it can't stay here, like that's just not probable. So you can make some assumptions on what you think is going to happen and then buy appropriately. But I'm a huge proponent in like, where are you buying the deal? What's the interest rate on it? What's the cap rate in your market? What do you think it's going to do? But let's just plan for it not to get better and buy it and operate it well and then see what happens. So for us right now, we look at the 10-year treasury, it's pretty flat and it has been for a while. And I think it's probably going to stay that way for a while. Again, no one knows. All of our big capital partners agree with that. We all are kind of assuming that, it's kind of where it should be, quite frankly. So, if for us, we're getting sub 6% loans, we're in that like 5.84% range with no buy downs. Like we're not kind of gaming it at all, which are killer. We're what, 3/4 of a point better than residential rates. That's because we're getting these agency loans that are sponsor specific and you have to have a track record and all of these things. So that's an advantage to investing in somebody that can get those loans. But we're not forecasting it. Like I think they're going to stay flat. I think over time they'll come down a bit. Something will happen to probably stimulate the economy. But if that happens, that just makes our deals look better. But in terms of our forecasting, we don't do anything that has anything to do with like needing that to happen for the deals to work.
All right, thank you. The next question is from Brian. He has 2 questions. First one, do you have an accredited investor? Do you have to be an accredited investor to invest? And what is the minimum investment required in your deals?
Yeah, so we traditionally have not advertised our deals. So we've just kept it inside of our network. It's like in network of network, people that know us. Maybe one of our investors refers us to somebody that. So we don't have to do the designation where everybody is verified and collected as accredited on those deals. If the day comes that we do decide to advertise and be more broad about it, then we will need to collect accreditation and everybody will have to be accredited. But for now, no. But in the future, maybe. And so that's the answer to that. And in terms of the minimum, we kind of go deal by deal. So I think of everything in terms of like how much admin will there be, what makes sense in terms of the group and what's best for the group. And so we try to keep the investor count per deal less than 15 or 20 people at the very most. So, you know, if it's a $1.5 million raise, that's going to be a different minimum than a $3 million raise. I would say usually our minimum is $50,000. That's probably what makes sense. But again, if somebody just wants to try us out or they just want to kind of dip their toe in and get some of their money working in this space, like we're open to the conversation and there's no actual minimum.
Got it. There are more questions here, but before that, related to what you asked, there was another question which came in from somebody who registered, and that's relating to the skin in the game. So in terms of your deals, what skin in the game do you have as sponsors? And can you walk us through with any past examples where obviously your own invested money was on the line?
Yeah, well, for the first 13 years, it was all my money. So, you know, like everything I had was on the line. So there's that. And I think that that is a cool thing when you're talking to sponsors, when you're talking to fund managers, you know, did they actually do it? And have they learned the hard lessons yet? Because we're always learning, we're always getting better. But I can confidently say now, and I would say for the last 5 years, the deals that we've done, there have been substantially less surprises than there were, you know, in the first 10 years that I was doing this. And that's just from experience. I think the only way that you can learn this is by getting burned, really. And that's the best way to learn the little tricks. I mean, even on inspections, it's like I can walk in a building and smell if there's been a water leak, you know, like it's just things like that, just because I've been burned by that before, you know, and some things don't show up on inspections. I think the skin in the game question is an interesting one. So there are a lot of syndicators out there that will try to say, I'm investing 150,000 or 300,000 or whatever the number is of my own money in this deal. That's how much I believe in it. You know, and that's what they try to use as like the confidence booster for the deal. We don't do that. So we don't put our own capital in these deals. It's just not scalable. So at the end of the day, you're investing with us because of our track record and our deals are good. And we believe in them because, first of all, if a deal goes sideways, we're probably out of business. You know, like we're not going to be able to get investors if we lose people's money. So that's, I mean, first and foremost. Secondly, and probably the biggest thing is these types of loans that we get are called agency loans. They're Freddie, Fannie, commercial loans. And if you have a single blip on any of your deals, and I'm talking like a reporting error or you're late by a week, you know, on a payment, you can get kind of branded in those agency loans and like never be able to get them again. And so, you know, I plan on doing this for another 50 years. I love it. Like everybody likes making money. So it's not like I'm, you know, altruistic all the time, right? But at the end of the day, I actually love this and it's really fun. And I want to do this until I'm dead. So if any of these go bad because we made a mistake and lost money, like it's way more than one deal, you know, in terms of risk to me, because it's me guaranteeing the loans. So that's the skin in the game. And I think when you're interviewing and talking to sponsors, if they're using like, hey, I'm putting money in this, like as the proof point on why you should also put money in it, like you should probably ask some more questions.
All right. DJ had a few questions. One is, what are your challenges on property management? And do you put your own people or do you reuse whoever exists?
Yeah, we never historically reuse who already exists. So this is a humongous, going back to that whole thing, you can buy a great deal, but if you don't operate it well, you're host. You know, it's just that's where these things get lost, is the property management piece. So it is in our market, and it might be different in other markets, but in the Pacific Northwest market, most institutions and hedge funds and, you know, gigantic funds, and I'm talking like $billion+ real estate funds, they will only buy deals that are 100 units and bigger. And the reason for that Well, sometimes it's because they just have so much money that they need to deploy that it's just a scale problem. So like they have to do that. They're also happy with substantially smaller returns than we are, so they'll pay more than we would for those. That's why we don't buy those buildings. Because we want to make typically 2 times what those groups are earning and on their deals in terms of returns. So we're staying there. The second piece is the management piece. And this is who we buy from a lot of the time. It is pretty universal that all real estate and particularly multifamily investors recognize these, $3 to $10 million apartment buildings are better from a return perspective than the 100+ unit buildings. Like I haven't met anybody that's actually in the game that refutes that. The management piece is where it breaks down for these groups, particularly these groups that are just like capital allocators and they're not actual operators. And so at 100 and up, sometimes 75 units, it depends on the deal, you can have on-site employees, doing the property management at the building. Like there's enough revenue from the rents and they're big enough to support a full-time staff there 24 hours a day. That's who ends up doing all the maintenance calls. If there's a tenant problem, they go collect it in person. Like it's a much kind of, it appears to be simpler of a model. What we have built out is a combination of in-house property management and third-party property management, depending on the location of the building, that is basically custom designed for these exact types of deals. And that took 15 years to figure out, so that wasn't like just, oh, we're going to plug in this thing and do it the same way that everybody else does it. There's a lot of moving parts. There's a lot of people. There's a lot of relationships that it takes to get it done. But we are essentially rolling that out across the board. But we are doing a combination of all of that. But it's just from trial and error.
Got it. Understood. The next question is about the exit, and I know you spoke about this in your deck, which is like 3 to 5 year period. Real estate in general, relative to other liquid assets, there are constraints around the liquidity portion of it, especially with interest rates and other things that could impact asset values. If somebody needs access to their capital earlier than what is anticipated, especially when the deal is getting stretched out towards 5 or
Sure.
more, how do
Yeah.
you think about that, and what options do investors have in such cases?
Yeah, so we're super clear with investors to say, hey, expect 5 to 7 years, and if it happens faster than that, cool. So we're trying to set expectations from the beginning. We're never telling somebody that, we've turned some of these in as quick as like 15 months. Like it just worked that way. But even then, the expectation was 5 to 7 years, like that's it, as far as I can tell, just from studying history in the markets, if you hold pretty much any real estate, but definitely with apartment buildings for 5 to 7 years, like you're going to make money on them. Like you can weather a storm, you can get through, it's going to recover, like you're probably going to be fine. Inside of all so like I mentioned earlier, every deal is its own LLC, it has its own bank account, and it has its own operating docs. So inside of those operating docs, there are buyout clauses. There are things that if people have a life event and they need their money, like they can call us and we'll do our very best to figure that out. They'll probably take some kind of haircut, in terms of what the actual value is, because it's going to be us going back to the investor base and ourselves and saying, hey, do we want to buy them out? We probably would, just because we like all of our deals. Like we spend a lot of time making sure we buy the right deals. But you're right. Like it's a relatively illiquid thing, and that's super rare. We've only had it happen one time in basically 15 years, and it's just not a thing that happens. Just because if you're getting that reliable cash flow, and you're also seeing the value of the building go up, and you're getting all the tax benefits along the way, it's a pretty hard nozzle to turn off unless you absolutely have to.
Right. The next question is from Chris. He asks, how does something unexpected like a pandemic impact your business?
Yeah, that was an interesting time. So I will never forget when I was like sitting in the morning watching the news and heard, Washingtonians, you no longer have to pay your rent, and I just was like absolutely shocked at that. And the reality is, I've always subscribed to the old Warren Buffett thing, and this is aggressive, but like when there's blood in the streets, you go by, right? Like it's just, so to me, I was like, hey, this is chaos. Like to my knowledge, that hasn't happened before. So first thing we did was make sure our tenants were educated. It was very vague in the news, what it was being translated to people in terms of like, you don't have to pay your rent. And the reality was you do have to pay your rent. you're either just not going to pay it now and you're going to pay it later. Like, so that's what we did. So like the first day that got announced and the eviction moratorium and stuff started, we made sure letters were on the doors and messages were out to all of our tenants and basically said, hey, if you're in trouble, if you're hurting from this, we'll help. Like we can set up payment plans. It's all good. But at the end of the day, if you're going to take advantage of these, rules and not pay what you should be paying, we're going to come for you, like, and we just made it really clear. And we actually were only down 6% in collections the entire time. And we bought a lot during that. Because again, during that time, debt was low, liquidity was high for people. We were able to go buy deals. And so we almost doubled our portfolio in that amount of time during that. So I was aggressively growing during that.
Right. And you, as a part of your onboarding and investor orientation, like, do people get to go and see these properties? And a related question to that is, in terms of your pipeline, do you want to share? I know you had Ridgeline, I think, as one of your subject properties, but you want to speak to any pipeline deals that is upcoming or in process?
Yeah, so we are always looking at deals. So we have a huge pipeline of off-market deals that we could take down at any time. So for us, it's basically just capital planning. So, we have an investor network, a lot of repeat investors. Like this Ridgeline deal is like 90% filled. So, we're still looking for a couple $100,000, but we have that one pretty much full. Once we get our kind of pause wrapped around that one and it's super dialed, that one will close in 75 days. So there's still, nothing happens fast in this, which I love. And again, if you meet somebody that is pressuring you and something, if they're like, hey, we're 2 weeks away and we're short on money, something went terribly wrong. Like what they weren't prepared to close the deal. They didn't actually have the investors. They didn't actually have the cash. Maybe the deal didn't appraise right. Their loan was off. They had to go get it. Like something went wrong. And that can happen, but it just doesn't happen with us. We don't lock a deal up until we're ready to go take it down. So I would say that it's the pipeline is, we could very simply take down $150 million a year worth of these things. There's just so many of them. And our network is so deep. We get 5 off-market deals sent to us every single week. We get 50 sent to us every single week in general. But there's 3 to 5 that all pencil and make sense and are good deals that we could theoretically be buying. So there's plenty of deals.
Got it. Cool. Does anybody else have any questions? You can type it or come off mute as well.
They were good so far.
I think we have one coming in. So I think DJ has another follow-up questions. But before that, I'll take one from Priya. How would you compare multifamily with just straight NNN lease?
Yeah. So triple net leases, that's commercial. So, you're thinking the strip centers with restaurants and, Jiffy Lubes and that kind of stuff. So those were great, and I had a mentor that had several $1 billion of strip centers across the country, very successful in the 70s and 80s, even 90s. The commercial world outside of multifamily is just in chaos right now. And, if you're a specialist in these triple net leases and you know exactly what to go get, like big anchor tenant buildings, like Home Depots or, Chick-fil-A's, like these types of things, and you have a lane and, you've only done that, then they can be okay. They're just more of like a cash flow play. The appreciation is just not as aggressive. So we can come in and do what's called forced appreciation on these things. So, we're coming in, we're raising the rents. They're valued based on the NOI. So a lot of these triple net leases, 5-10 years long, there's baked in increases, but they're pretty fixed. There's just not as much control there. So, if you had $100 million and you just wanted like 6 to 8%, drip money and not the appreciation side, like could be a good way to go, but I just prefer the control and the operational ability of the multifamily deals.
Got it. DJ is asking, you said this is a passive investment. What tax benefits can we think of with this type of investment?
Great question. The exact same ones as if you bought it yourself. And that's the cool part. So all of our investors are partners in the deal. So you own a fractional piece of the deal depending on how much cash you brought to the table. So you get a K1 every single year. We are known for maybe the fastest K1 distribution group, at least in our area. So we have them out first week of February, which is really, really rare. So a lot of times with syndicators or funds, the K1s are causing people to have to extend their taxes because they're not ready in time for the deadlines. But you get a negative K1 and you're going to benefit from all the depreciation and the bonus depreciation. And it's called a cost segregation study that you can do. And you're getting all of the exact same benefits as if you bought it yourself. So that might be my favorite part of this whole game is the tax shelter side. It's really straightforward. There's a lot of opportunity in that. And it would be kind of shocking to me if someone received a positive K1 because of that, even if you received cash flow in the year.
Right. So this, I'm assuming, also relieves them from that minimum real estate hours, something that IRS dictates to get the depreciation bonus and all that.
So it depends. Yeah, it depends on your specific situation. That's not our decision, what you do with so that's your CPA's decision. But there are some regulations in terms of what type of income you can offset with the depreciation stuff off the real estate, what your other investments look like. So we always just say, hey, like talk to your CPA about what you can do with this, but we're going to hand you typically, and especially in the first 2 years, a very big negative K1. So it depends on specific situations on what you can and cannot utilize, but you'll get it no matter what. At the
Right.
very minimum, you're not paying tax on your distributions. So if somebody put $100,000 in and they got $8,000 in the calendar year, K1 comes back negative $6,000. Like that's what you're reporting on your taxes. You might not be able to leverage the negative to offset your W-2 income, depending on what you do and what your investments are, but you're not paying tax on the 8. So it's a huge positive no matter what.
And then on the capital gains, what's the treatment like when there is an exit?
Yeah. So this is where I would say 9 out of 10 of our deals, our investors want a 1031 because that's one of the greatest wealth generation tools in the world, in my opinion. A 1031 exchange is when if we buy this building for $4 million and we raise $1.9 million in cash to buy this thing. If we sell it for $6 million, then we're sitting on $3.7 million instead of $1.9 million. We take all 3.7 of that. We go then buy, instead of a $4 million deal, we might go buy a $9 million deal and your basis goes up. So now your cash flow is being triggered off, maybe your $100,000 investment turned to $175,000 in value. Your 6% or whatever the distribution is for the deal is being triggered off 175, so then you just keep doing that. You are technically deferring your taxes. So it's not like you never have to pay them unless you die with it, and that's the best way. That's the best way you could perpetually 1031. And from an estate planning perspective, the step up in basis and everything for heirs and all that is an amazing tool. But if you decide not to, and investors can choose this, there's never pressure. So if somebody just wants to be in one deal, we basically send a message out and say, hey, this deal is ready to sell. Your $100,000 is now worth 175, ish when we sell it after closing costs and everything. Do you want to roll it into another deal, or do you want to cash it out and take your money back? And there's never a forcing function either way. If you decide if we're going to just close the deal down and give everybody their money back, then it's a win and it's a capital gain situation. So, and it's always going to be long term. We're not going to hold them, that short. So,
Makes sense. I see a message about chat being disabled. If that is the case, you are allowed to come off mute if you have a question. We have another question from Priya. She's asking about, let me read it. This is a long one. Thanks for answering multifamily versus NNN lease. I think you call it
triple
something, but
net. Yeah.
triple net, and helping us to understand multifamily allows flexibility to improve NOI as things go versus commercial leases or fixed over the long tenure. In terms of ROI, what would be the difference between the two? Also, what's the implication on taxes if the properties are outside of state you live in?
So your tax implications, I believe, are based on your personal situation. So, that would be like your residence and where you live. It's no different than, if you invested in a stock that the company's based in New York or something. It's like you're still paying taxes based on where you live. So it's the same there. The ROI question, it depends on the deal. Like there isn't like a blanket answer, but from what I've seen in terms of like real life and how these things actually go, this exact thesis and like our returns are probably about double. what you would get
Mm.
compared to like the commercial investments, like those triple net lease investments. The one positive on the triple net lease investments for the operator, not for the passive investor, but for the operator, is they're easier to manage. You know, there's only a couple tenants. They're taking care of their own, you know, space. They're doing improvements, like all of that stuff. So it is better from that perspective.
Got
But
it.
that's irrelevant to the passive investor, so it shouldn't matter to you.
Right. Okay, there was a capital gains question which you already addressed in terms of the 1031 and deferring the taxes. Any other question from the audience? Cool. Now, this was a very interesting session, Alex. Really appreciate the time and sharing the wisdom. What's the best way to get in touch with you? We can, of course, share your details. But is there
Yeah.
anything that you are going to share that we can distribute with the audience to refer as a follow-up?
Yeah, I'd be happy to send our deck out so, you know, people can review that. There's a lot of information in terms of like what we buy, why we buy it. It's really educational, and that's what we want, is we want educated investors. You know, like we want people to understand what we're doing, why we're doing it. We're super passionate about, you know, the types of deals we buy and why we're buying them. And I think the best thing is for everybody to also be passionate about it. So our deck is designed to be more educational than anything, and then the information on the separate deals will be in there too, but not, it's mostly just an educational piece. So we can ship that out. And then our website, you know, has all of our contact information, veritasequitypartners.com, cell phone, emails, all that stuff. So we're super accessible.
Sounds great. Well, thank you everyone for being a part of the conversation today. We will continue to bring in experienced voices as Alex has today through this series, and we look forward to hosting our next series. Thank you again for joining, and you all have a pleasant evening. Thank you, Alex.
Thank you.